So we just wanted to, jump on and do a fairly quick webinar on the differences between true commercial loans and, what traditional residential loan officers will see as DSCR and non-QM loans. And so we created this webinar to show the differences and, make you more familiar with, commercial loans and financing in general. So, all right. Okay. So just a quick intro. My name is Derek Torno. I'm co-founder of Commercial Loan Training. I also I'm a managing partner of M5 Commercial Funding, a brokerage. Been doing commercial loans over 10 years. Done a lot of different types of commercial loans. Done almost $1 billion worth of commercial loans in the last 10 years. So we do a lot of loans that are our little boutique commercial brokers that we have. So.
And I'm Colton Smith. Good to have you guys with us again. Thanks for joining. I'm with Walker & Dunlop. We are one of the nation's largest commercial loan brokerages, doing over $75 billion a year in lending. I've been doing it for 22 years now, over $4 billion in loans closed. And we're also a direct Fannie Mae, Freddie Mac, and HUD apartment lender, which is different than the residential side. So Derek and I together created commercial loan training so that we could teach residential loan officers how to do commercial loans. And this webinar specifically is based on feedback that we've received over the last few years. It seems as though the vast majority of MLOs that we speak with have a different view of what commercial loans are than what we call true commercial loans. And so that's what we're going to go over here in this webinar.
Great. All right, let's jump right in. Okay, so, what is a DSCR, non-QM loans as perceived by, MLOs? They're typically, single-family investment properties, 1 to 4 units. They're also small, multifamily apartment complexes, 5 to 10 units. They're, typically limited to the number of units on the size of the apartment complex. They will traditionally do, some retail, some office, some industrial. They're typically limited to the loan amount. They like to, stick around $2 million. However, they may say they'll go up to even as much as $5 million. But what we've seen is that their sweet spot is right there at $2 million. And, to get them going above $2 million is fairly tricky and takes, additional underwriting and a lot more scrutinizing of the deal. So there are quite a few limitations when it comes to, DSCR and non-QM loans. One thing that, just to go back to what we were talking about is, a lot of MOs that we've talked to is they consider that it being commercial because they were able to fund the loan in an entity, traditionally as an LLC that they're able to fund in, which is, drastically different than the residential where they have to, fund the deal in their name, be the guarantor. And so the limitations right here on the DSCR is credit score. In commercial financing, through commercial financing, we're not limited by the credit score, loan amount, and like I mentioned before, $2 million is kind of their sweet spot. The property type, so they like to see the vanilla type properties, office, warehouse, retail. When it gets outside of the vanilla type, they typically will turn down those deals. Property locations. Property location is a big one. They like to be in, much larger MSAs. And, by that, you're limited, if you have a property that's just outside of a much larger MSA, The reason behind that is they feel like they can't find, comparable sales or, come up with a value of the property, since it's outside of a larger MSA. Amortization, they typically will, amortize the loan, over 30 years, and then prepayment penalties. We found that they have, long prepayment penalties where, they are, a 5-year, but it's a declining 5-year, or if it's 7 years, then it's a 7-year declining 10 years. So, and they're high. They're, 5%, prepayment penalties for a 5-year. 7, there again, it's 5%, but it's over a longer period of time, and so it's not as favorable for the borrower when it comes to the prepayment penalties. And then, DSCR requirements is, there are limitations on the DSCR. So, and then the main limitation with the DSCR non-QM is the higher interest rates. We see that, there are a lot of lenders that will target loan officers as, their commercial loan programs. And when you dig into it, their interest rates are anywhere from 9.5% up to 13%. And so it's ouch.
Yeah. Stay tuned for what true commercial rates are.
Yeah.
But this is really interesting. So this is, and write in the comments if you think there are different reasons. But again, over the last few years, when we've spoken to many of you and hundreds of MLOs across the country, we think there's several reasons why MLOs in general have this perception of what commercial is. And the number one reason we hear is that, hey, if you could borrow as an LLC instead of an individual, that falls, then that's a commercial loan. And I think that's very interesting, and in some sense it's true, because in true commercial loans, you can borrow under an LLC, but you could also borrow under an individual and any other trust or entity that you could think of. But that's the number one reason. And the number two reason that we come across is, or that they consider these as commercial loans is, we hear the term blanket loan all the time. Blanket loans kind of refer to, one single loan that covers a whole bunch of residential properties. And again, it's true, those are commercial type loans, but they are, they're the types of loans that in the true commercial world, we actually don't even refer to them as commercial loans. We don't even really do a ton of them ourselves. They are mostly done actually in your world more than our world, which is interesting. But this is, in my opinion, this is the biggest reason that we see. I won't name names because I think you all have them in your head, but there are a certain few lenders over the past 20 years that I've known that I've never even sent a deal to, that market specifically to you as residential loan officers. And they're basically just hard money lenders, and they want to do and capture some commercial type loans. And those are the types of loans that we mentioned at the very beginning, the multifamily kind of 5 to 10 units, sometimes they do the blanket loans, and very, very small commercial. And so they gear their entire platform and product to appeal to the mass audience of the residential loan officer. And so everything that you see from them, again, you can picture who they are in your head. They're good lenders. They're very good, but all they do is market to you, and they make you believe that that's the world of commercial. And it couldn't be further from the truth. But that's what you see from those lenders, and they find a niche there to be able to market to. And then the other very similar reason is Scotsman Guide. Scotsman Guide, again, is a great tool. We know them. They're good people in general, too. And they provide a great service. But when it comes to, and some of you may know this already, and some may not, but when it comes to a lender search specifically for commercial loans, what do we come up with, Eric?
We come up with traditionally hard money lenders. And so
there might be a nugget in there every once in a while, but we've done searches just for fun over the last month or two, and have not found one what we call legitimate conventional commercial lender in Scotsman Guide. And there's a lot of reasons for that. We could talk offline about that, but the Scotsman Guide make their money off of the lenders being able to list themselves as lenders within Scotsman Guide. And as a whole, commercial real estate lenders, they know where to go to get their commercial loans. And it's typically with your large institutional commercial real estate brokerages. And so they don't find a need to market within Scotsman Guide. And so, but what you have left over are those same lenders that we talked about before that market specifically to residential loan officers, and that's how it goes. And Scott said that he found that SG has inaccurate info 90% of the time. That's interesting. It's possibly true. I think the lenders that we find are correct lenders, that they do commercial, but even if you do a search right now, we did a search yesterday in Scotsman Guide. We said, okay, we've got a $2 million acquisition of an apartment complex in Los Angeles, California, with 40% down, and it's an investor, LLC owner, just kind of your most just generic loan possible. And Scotsman Guide came up with 3 lenders, and all 3 of them were apartment money lenders in the 9.5% to 12% range, which is terrible for funding those loans.
And so, when you've had a taste of those type of lenders, they kind of will taint the commercial loan industry, because, if you're not necessarily familiar with true commercial financing or the lenders or the rates and terms that are available, you may say, well, commercial, interest rates are too expensive, and my client can't afford that. And so, the whole idea behind this is to make you more familiar with true commercial loans and, the benefit of getting into, the commercial financing business.
So here's what we consider true commercial loans and properties.
And as you can see, we have a picture of all different types of properties here. You guys, every day drive by commercial properties. There's office, there's retail. Now, retail is broken into shopping centers,
power centers, neighborhood centers, grocery anchored centers.
Yeah, restaurants.
Single tenant net lease, like Arby's and Burger King and
Taco Bell. Yeah.
My favorite, Chick-fil-A.
Yeah.
I've got a problem with Chick-fil-A.
Multifamily apartment complexes. There again, 5 units and greater, that's unlimited on the number of units. Industrial, warehouses, hospitality, those are hotels, motels, bed and breakfast, self-storage, and then the more specialty type properties, gas stations, car washes, restaurants. So this is commercial in a nutshell. So.
And keep in mind, most of these actually start at a higher dollar amount. Yes, there are office buildings that are valued at $1 million or less, but most of these are valued at $3, $4, $5 million and above. And the commercial lenders that market to residential loan officers don't have the capacity or know-how to do those loans. And so it's kind of just a different world. It's a step up. And these are more, they're easier to execute, easier to close loans on, more sophisticated borrowers that own multiple properties within multiple asset types. So that's kind of what, when we do commercial, we've been doing, again, 20 plus years, this is commercial to us. So the blanket loans, that's not really commercial. Yes, it falls under the commercial world, but it doesn't fall into the main category types, which you see here on the screen.
All right, key differences, loan amounts. In commercial world, we could go down all the way down to $250,000 if we wanted to, but we also can go up to hundreds of millions of dollars. The average commercial loan size across the country is right around $5 million. And so, borrower types, there again, of course, they can fund it in the borrower's personal name. We don't necessarily recommend that, but typically it's an LLC, it could be a trust. There's lots of different borrower types. Recourse and non-recourse. We have the ability to, fund deals non-recourse where the borrower is not a personal guarantor of the transaction, the deal. The rates are much lower. Right now they're starting at about 5.5%. You may be fairly surprised, that they're even lower than residential lending right now. So and we're seeing the trend right now with the market is that the treasuries are going down. So my personal opinion is that it's an election year, and we typically see that in election year. And so, we're going to see maybe even a couple more rate drops this year. Lenders. And so it's not just the hard money type lenders, 9 to 13%. There's of course the banks and credit unions, but there's also some other great lenders that are the CMBS, LifeCo, agency, hedge funds, etc. That that offering these 5.5 to 6.5% interest rates.
Here's why, and the last point too. I mean, obviously, larger deals, larger commissions, and we'll go over some deals here soon. But here's why this makes a difference. When a client comes to you, maybe they've been a client of yours doing residential loans, or a referral network source of yours, whatever it might be, and they say, "Hey, I've got a commercial loan. It's a retail strip center. It's $5 million. It's a great deal, so on and so forth." Before now, most residential loan officers will say, "Okay, great, yeah, I could do this," and they'll send it to one of those lenders from Scotsman Guide or those others that and they're going to quote and come back at 9, 9.5, 10, 11%. And when we know that there's 5.5, 6.5, 7.5% money out there for that deal, your probability of winning that deal with that small bit of knowledge and relationship with lenders is slim to none. Especially if that client knows anything about commercial real estate and has any sort of relationships with any sort of broker, lender, anything in the world of commercial lending. And so it's extremely important, if you're going to tackle some commercial loans, that you have all the pieces, that kind of what the market looks like, so that you kind of don't look silly by quoting a 9.5% rate when it's really should be 6.5, depending on what it looks like. And so that is a huge thing for probabilities. We're here to make sure that you guys make money and don't waste your time. And the biggest problem that we see with commercial loans with residential loan officers is that they waste hours, days, weeks, months on deals that if we looked at it, we could tell within 30 seconds that it's not a deal that would get done at all. For various reasons, financially, borrower strength, whatever it might be. But it's easy for us to size a deal, know whether or not it's doable immediately, and if you don't know that, then you're wasting your time. And rate is one of those big things too. Even if it's a doable deal, your client's not going to say yes to a 9.5 to 10% interest rate.
Especially if they're rate conscious, or they're looking for a specific monthly payment to make the deal work. So, all right, the power of diversification. So, all right, now you're all familiar with doing residential loans. You've probably all been doing them for many years. You've seen every type of residential loan come at you. The power of diversification is having the ability to not just do residential, but to also do commercial financing, and do commercial financing well with, the different loan programs and loan options, for your borrowers. Because time and time again, we talk to residential loan officers, and they have a deal, or they've missed out on deals because they turn them down because they're not familiar with commercial financing. So, you could have an advantage over your competition, other loan officers, by, being familiar and being competent to do, commercial loans. Another benefit of knowing how to do commercial loans is it's an additional source of income. When rates are high on the residential and inventory is low and refinances are down, why not, take advantage of doing commercial financing when commercial loans right now are out there. There's, trillions and trillions of dollars worth of commercial loans that are constantly coming due. Commercial loans, they typically are not amortized over 30 years. They're not fully amortized. They're not, a full 30-year term. They're typically a 5 to 7 year term. So, every few years, borrowers are looking to refinance, pull some cash out, invest in other commercial deals. Take advantage of doing commercial loans and making more money. Also, you have different client base, and as Colton can share on that. There's a lot of different types of clients that in the commercial world. So.
Yeah, so the diversification is very interesting because people put residential in one box and commercial in one box. And, that's probably not true on either side, but the macro market for residential financing, especially, owner user, single family homes, it's kind of comes ebbs and flows with where interest rates are. So interest rates went up, and so purchasing has gone down significantly in many markets for residential. That's not the case in commercial. Commercial, you have all those different property types that we went through, and they all go through different cycles, and they all have their different macro and micro markets. For example, right now as a whole, office buildings. Don't touch office buildings because of what happened during COVID. A lot of office buildings have a big amount of vacancy, and the commercial world is still trying to figure that out. But that doesn't represent all of commercial. In fact, it represents a very small percentage of commercial overall. What's doing very well still? Apartments, industrial, retail made a huge rebound from COVID. Hotels made a massive rebound from COVID. So out of all the main property types, really right now, there's only one property type that investors don't want to buy. They don't want to invest in. They can't refinance. And so you have all these other property types that are out there that you could diversify with your client base and your lending. And commercial is different in the sense that it's an investment. Just like a stock, a bond, annuity, whatever, the client, the investor has a return on their investment that they want to hit, a target return. And even if the interest rate is 12 or 15%, if they hit that return by buying that property and taking that cash flow, then they'll buy that property at a 12%. Now, obviously, we now know that rates are not 12%; they're 5.5 plus in the much lower range, and so that helps the returns a lot more. So that's why these investors are buying still right now in this market. And like Derek said, there's a capital event every 3 to 5 years for every commercial owner, meaning they might want to refinance because rates are better. They might want to take cash out to reinvest in other properties. They might have to, might want to buy off a partner. They might have unfortunately a death of a spouse or a partner, which might cause them to sell the property. There are endless amount of capital events that are out there that are in need. They're in need of financing. And then diversity of client base, like Derek was talking about. You have every sort of owner that you could think of. You have your large institutional owners like Blackstone and KKR and Ares and all those that are your big institutional buyers. You have your kind of mid-range buyers and developers. You have syndicators, people like you and me that want to go buy an apartment complex. We don't have the money to do it. And so we go raise the money from friends and family, investors, even from broker dealers to go buy that property, and so on and so on and so on. There's just an unlimited source of buyers and lenders and money out there for commercial real estate right now, still in demand, depending on the specific market, specific property type, returns, so on and so forth. So there's a lot of possibility there.
Yeah. And then the variety of transactions. So the variety of transactions mostly has to deal with the types of the property types. Right now, I'm doing everything from a Walgreens purchase to the shopping center to warehouses, and then we do a lot of SBA financing, boarding homes, assisted living, daycares. We're doing office buildings for owner users. And so you'll see a variety of property types, everything from business owners like Colton mentioned to, power investors that are very savvy and experienced. And so,
so here's just an example. So in case you need some more specific examples of what we have done recently and what we believe or what we know true commercial really looks like and transactions look like in the real world, here's what they look like.
So here we go. So we have a mixed-use office building. This particular borrower, he purchased a corner, a full corner in this town. He tore down the building, rebuilt it with construction funding that we got him, and then he came back around and we got him long-term financing. So the loan amount was $2.9 million. Interest rate was 6.25%. Here again, it was a 25-year amortization, and we charged him 1 point on the deal. He's a repeat customer for us and client that we've had for many, many years. Here's another property right here. Situation, a dentist looking for some cash out refinance. Fairly simple deal. And, we refinanced his office building, $1.75 million. And there again, made 1.5 points off this deal. Fairly easy deal, owner-user property. So. Here again, this is the same client that on the first slide that we showed you that he bought the purchase to the whole corner at that town. Well, he built an apartment complex, and so this apartment complex, he built it. We got him the construction financing. There again, we had to come back around and also do long-term financing for him, and the $5 million, refinance. We got him into a agency financing, Fannie, small balance, and it's a 30-year amortization. And there again, we charged him 1.5 points and made a good fee on that. So, yeah.
Another multifamily complex that was done through actually a CMBS lender. CMBS is commercial mortgage-backed securities. Where we, here's the numbers right here. We were able to get a 30-year amortization on that one, a large deal, $52 million, and the rate was 5.65%. This was actually, I believe, a student housing property, and so this is where, looks like a traditional apartment complex, but students live there because it's close to a Power 5 conference, which is also part of the multifamily world. Another apartment complex that I did downtown Salt Lake City was another Fannie Mae loan. This was actually a good example of an interest rate of 4.98%. We were able to, like you are accustomed to in the residential world, we were able to buy down the interest rate. Someone just said, wow, under 5%. Yeah, we could still get rates under 5% by buying down the interest rate. And we could buy that down 2 to 3 points on with some lender types, mainly Fannie, Freddie, and HUD. And so this was a huge win for the borrower because the cost to buy down that rate was the benefit of that was much greater than the cost. And so, and that's the dynamics of the market right now. You could buy down rate, and it makes sense financially to do that because by buying down the rate is directly tied to the loan amount actually, what loan amount you're able to get. And so that's why we're able to get a higher loan amount for the borrower, which means he put less money down, which means his cash on cash return for his investors were much better. This is my favorite part about commercial lending is that you get to play with those numbers, show cash on cash returns for the investor, and be a real true consultant with them. So it's kind of fun to do that. The other that we didn't put in here, just a side note, because I'm excited about it. We just locked a interest rate on a deal that's going to close next month, $29 million loan amount that we got 4.8% on. And that's obviously in the high end of the commission range, but that's kind of what's out there and available, even for brand new commercial loan officers or residential loan officers that are getting brand new into commercial lending. And that's what we do. This is what we do. And we appreciate there's actually quite a few of you on this call right now that have come to our commercial loan mastery courses in the past. And we won't belabor this topic, but if you want to schedule a call with Derek or myself personally to go over what we teach, we could do that. But in short, we teach residential loan officers on how to market, originate, underwrite, process, and close commercial loans. We give you a list of lenders, we give you a list of leads, and we give you all of our loan templates. We literally teach you in a 3-day live course how to do this. And it's kind of a heads down working session for 3 days, and we give you a lot of information and support to be able to further your business. So if you want to learn more about it, I'm going to try and put the link to the chat, inner chat onto the call schedule. If I can figure out how to do that on my iPad, and you're welcome to do that. The next courses are actually next week, Los Angeles, late next month in Austin, and in July in Miami. I don't know why we decided to be in hot Miami in July. That's the worst timing ever. So
we planned it in the winter.
yeah, that's right. So let's get, and these are more specifically what we teach. If you go to commercialloanmastery.com, which someone asked what the name of the company is, it's Commercial Loan Training is the name of the company. Commercialloanmastery.com is the course. Question and answer period. So let me go through a couple of the webinar chat questions first. I saw a lot of questions related to licensing.
Yes. And so just off the bat, if you have any concerns about licensing, call the state that you're doing the deal in, or call the state where you're at to, hear it directly from them.
We're not attorneys.
We're not attorneys.
We cannot endorse this, but we will tell you what we know.
So what we know is that there's over 40 states that don't require any type of commercial licensing to broker commercial loans.
At all.
And so there are some, bigger states like California, Nevada, Arizona, that do require to have some sort of residential loan officer license to broker commercial loans.
But there's no specific commercial lending license that exists anywhere in the United States.
Yeah. And then, someone mentioned, Florida and Texas. Our understanding, I've called, both of those states recently, and they said that there is no licensing requirements for either one of those states. So, but double check. And it's kind of like the wild, wild west when it comes to, doing, commercial loans. Like I mentioned before, over 40 states. So, if you have a deal in the middle of nowhere, Oklahoma or Utah or Florida, Texas, you can definitely do, commercial loans out there and get paid to make money.
And this is the other question we cannot answer because it's more specific to your situation. But we received a few questions in the chat similar to this, which is, hey, I'm a residential loan officer. I work for a broker in whatever state, and can I do commercial loans with a separate entity or whatever? The answer is maybe, but it depends on two things. Number one, the licensing requirement in your state. So if you're in California, that's very hard to do. But it also has to do with your relationship with your broker. Did you sign something that requires all lending activities to go through that broker? If not, I would still suggest that you discuss that with your broker so that you are above board. Most brokers and most people that we talk to, brokers don't want to have anything to do with commercial, or if they do, they don't have any support. And so it doesn't really fall under their split structure. So they might negotiate a separate deal or just say, yeah, you could do commercial loans and you could take all the money yourself, commissions, whatever you want to do there. And if that's okay with them, then that's okay. The other thing that is very astounding to me, that is just natural and normal for me, but we seem to get this from almost every residential loan officer in the country, is, hey, who do you have relationships with as lenders? Or do you have to have a broker relationship with lenders or wholesale relationship with lenders? This might blow your minds, but 99% of the lenders out there in the entire United States of America do not require a broker package, don't require you to sign up with them, to be approved with them. It's a kind of the wild, wild west. If you have a deal that fits their box, they'll look at the deal, period. So essentially, almost every commercial lender out there in the country is available to you without having to get approved through them. And that's one of the things that we teach in the course, and we give you a starter list of lenders that you can call directly and not have to get approved with. Okay, those are the main questions that I saw. Are there any other questions from someone that wants to jump on and ask live here over the webinar?
So I see a question about construction on Airbnbs. Do those qualify? Typically, Airbnbs don't qualify as commercial. However, a little pro tip here, Airbnbs, they may qualify for SBA financing. I have financed a large cabin in Utah on the Fair Lake, and it was a $3 million purchase, and we were able to finance that through SBA, 10% down. So that is an option. It will be mostly determined by the location and the experience of the borrower. If the borrower has, Airbnb experience, and if they're going to run it as a business or a second home. So hopefully it's more of a business than a second home. And yes, you can do it through SBA, but other traditional commercial lenders don't look at Airbnbs as commercial properties.
Two other questions that came up, non-recourse versus recourse. Yes. A lot of the larger true commercial lenders will offer a non-recourse loan to investment property borrowers. So that borrower does not have any personal guarantee, is not personally on the hook for that loan. The reason they could do that is it's based on the property fundamentals and cash flow itself. So their primary source of repayment in that scenario is the property. So in that case, if the property cash flow is well enough, it's a good secure investment for the lender, then they will offer a loan with non-recourse. The ones that require a personal guarantee are usually the banks and credit unions that are lenders, and they're usually either an owner-operated business property, or they're a smaller commercial loan that can't get done with the larger commercial lenders. Then the other was what referral fee do we pay? Just to clarify, so Derek and I both are brokers, but I'm a mortgage banker. I'm a direct lender as well, so I'm a direct Fannie, Freddie, and HUD lender for multifamily. But everything else outside of that, I broker as well. And so we have relationships with all the top lenders in the entire country. We don't just have 10 or 15. We have every single relationship in the entire country with lenders that are valid. I'm sure there's some that we haven't heard of or don't do business with, but the good lenders with the best rates and best terms, we have the relationships with ourselves. We have a lot of students that just send us the referrals. We can do that. We pay a 20% referral fee of our gross commissions in general, which is the market standard across the country. So if you're one of the thousands, if not tens of thousands of residential loan officers that we've heard from that just either deny the deal or send it out to someone as a referral and don't get paid, you could send it to us and we'll get it done and get it paid, get you paid, send you a check in the mail for that if you want. That wasn't the purpose of our call, but the question came up and that's it. Can we finance 100-unit condo? David Tran said, ground up developments and rates and terms, what might they look like? That's a loaded question. The answer is yes, absolutely. We could finance any ground up construction development. The question is, are the condos for sale or are they for rent condos? Is it for rent for sale development? That makes a difference in rates and terms. But in general, right now, construction rates are actually the highest. They're, call it somewhere between 7.5% and 9%. And that is directly related to the Fed funds rate and what they're doing. So when the Feds lower their interest rates, those construction loans rates will go down. but those are very difficult loans to do. They take a long time. They pay you a little bit less, but if you have a captive client, then yeah, that's something that we could do. Someone else said, Dane, Dane's active. Thanks, Dane. I had a guy tell me life insurance companies are the main funders of commercial loans and not banks. Is that true? And you want me to look at your other question? Dane, you're quite bossy. You want us to take a look at all your questions. I'm just kidding. That's fine. Life insurance companies are not the primary funders of commercial loans. It's actually very hard to see because not all loans are publicly available and recorded. But the biggest source of commercial lenders is actually banks and credit unions. That is the largest by dollar volume in the United States of commercial lending. Life insurance companies are actually on the smaller end. The reason being is that they're very picky. They are the best interest rates in the country, typically, life insurance companies. But they are harder to get deals done with. They're very conservative, and they will not do deals with any and every broker out there, honestly. They only do, the way their system is that they have their correspondent broker relationships in every state, that they will only do business with those correspondent relationships.
Yeah. For banks and credit unions, I mean, they would do deals under $1 million. Most life insurance companies, you know, they like to do deals $5 million, $10 million, $15 million plus. So it's not higher.
Yeah. And Dane, maybe you have to chime up on this one on the daisy chaining, but you said that every, quote, commercial lender that you see was daisy chaining. So yeah, you get a lot of fakers out there. You have a lot of brokers that claim they're commercial lenders, and then so you send a deal to them, and then they will go broker it out to someone else. Mm-hmm. I would make sure that if you talk to someone that says they could do a commercial loan, you understand the relationship. It's not bad to daisy chain, but it also can ruin a deal. So the recommendation I have there, Dane, is number one, when you talk to someone that says they could do your loan, verify, are you a broker? Are you a commercial lender? A direct lender for this property? Because I'm a direct lender, but I may not be a direct lender for what your scenario is. And so I would never say, oh yeah, I'm your direct lender, and then go broker it out. I don't like that because the probabilities of me closing the deal are much smaller as well. But my recommendation always is control your borrower. So if you are going to daisy chain the deal, which I prefer you not, but if you're going to, then you control the interaction between the borrower and the lender, and that helps you control and assess probabilities of closing the deal. So the question is, what are the top 5 examples of true commercial lenders? Again, we listed them out. They're banks, credit unions, CMBS, agency, life companies, debt funds, hedge funds, pension funds. There's a lot of them. There's a lot of categories, and there's hundreds of lenders within each category. But those are the main types of lenders. Hopefully that answered your question, Dane.
What's the typical closing time? Typical closing time for commercial financing is 45, 60 days, where you're at.
Depending on the deal, though. The deal that I'm closing, the $29 million deal, guess what? That was a HUD loan, and that took 8 months. 8 months to close. And that's typical timeline for HUD. But that's, sorry, actually that one was faster. I think that was 5 or 6 months. But typical timeline for HUD is much longer. But your typical conventional commercial kind of run-of-the-mill deal, 45 to 60 days is very common.
Yeah. So M5 funding, yeah. So M5 funding, we do have our own in-house funds, but we are mainly a commercial broker. So we don't daisy chain. We broker directly to lenders. We have great relationships with lenders all over the country. So.
Miguel Cordoso says, I had many inquiries for foreign nationals looking to finance many types of commercial properties. I didn't catch the rest of your comment there. It cut off on the comments. But yes, that's actually one of the benefits of a non-recourse loan, is that there are a lot of lenders, if it's the right property type and right execution, that'll do a non-recourse loan to foreign nationals as well. Every lender will have their different requirements as to what that looks like, and some will require that a foreign national has some assets in the United States, like a bank account, or a hard asset like real estate. Some won't require that. Some will require that they have a visa or a green card. So there's a lot of different requirements based on the specific situation. But yes, it is way more common to be able to get a loan done for a foreign national in the commercial world than it is residential, as I understand.
Yeah, if you have those hookups, with foreign nationals that live outside the country, want to invest in the States, there's great loan programs out there where, they don't have to provide tax returns. So, all right. What about auto financing, like construction, trucks and cranes and excavators, skid steers, equipment financing? Yeah, equipment financing. I do a lot of equipment financing also. This webinar is mainly talking about real estate financing. However, working capital equipment financing, yes, there's those options. Equipment leasing, you've probably heard that phrase. And so, yeah, there's different lenders out there. There's different loan programs for that. And so they typically, when it comes to equipment financing, it's anywhere from 0 down to 10-15% down. So it's typically the terms, and the lease term can be anywhere from 3 to 10 years. So
probably the most common question we get is, how does one's credit score fit into commercial loan approval?
Yeah, so with commercial loans, you have to have a 780 or more. No.
Just joking. No.
Or just kidding, guys.
I'm totally kidding.
Yeah. So mostly credit score doesn't matter in commercial financing. It's not an initial question that we ask or lenders ask. They don't have to have a 720 or a 680 or even a 650 or 630. So they will pull the credit score on recourse loans, but they're mainly looking for derogatory, late payments on mortgages, little things like late payments on credit cards or missed car payments. Those things don't typically matter. They'll have the borrower fill out a letter of explanation on, why they had a late payment on a credit card 3 years ago if it's still showing up. But, credit scores aren't a big deal. So,
yeah, this might blow your mind, but I don't know if I've ever, in the history of my career in 22 years, ever had credit score or FICO score come up in the beginning of a loan. That just might blow your mind, but that is not a discussion that is had early in the loan process unless the borrower knows that he has major credit issues. And doesn't mean credit score is not important, but the primary focus for most every lender in the country is the property. How does the property cash flow? What does the property look like? If that then checks the box, if their quick underwriting looks good, then they'll move on to the next step and they'll start looking at everything else, in which case they might ask the question. But a lot of lenders don't even have minimum FICO score requirements. Of course, if you have a bad credit and you have late payments and foreclosures and that gets sniffed out, of course, that's going to be an issue. But most true commercial real estate investors are high or ultra high net worth individuals. And those individuals have figured their credit out for the most part. And so it's usually assumed that the credit of an individual buying an commercial investment property is good.
Yeah. So Mitch had a question about how to sniff out, true commercial lenders. It's actually very difficult. It's not easy at all. And the reason is, true commercial lenders, they don't market, they don't advertise. They actually, the ones that we work with, they don't want to be found. They don't want to work with, people that aren't familiar with the process of doing commercial loans. And so, they have, their deal flow and they're comfortable with that. But they're always willing to look at other deals as long as, the deal is packaged correctly and they're working with somebody that's, familiar with, commercial financing. But yeah, it's not easy to find, true commercial lenders. And the lenders that you are able to find, they're either not true commercial lenders or they have nasty interest rates that may turn off your your savvy, experienced commercial borrower. So, all right, we'll take a few more questions. Eddie had a question about, new franchises, looking for working capital is what we call it. But, so new companies in general, new businesses, it's difficult to get working capital for them because they typically need to show historical financials and show the ability to, repay the monthly payments. And so if they're starting from scratch and they want to, get something off the ground, sure, there's SBA financing, which is available, and they have, loan programs, especially for startups, $50,000 to $100,000 if that's what they're looking for. If they're looking for anything above that, there's also some projection based financing. Not a lot of SBA lenders are comfortable with that unless they have some sort of collateral that they can pledge, and more than likely what they like to see is a personal residence. So if they're willing to pledge a personal residence with equity, they're willing to do that. And we did a new business. It was a borrower that was coming from a totally different industry, didn't have experience in this new industry, was looking to do a startup, and he had to pledge his residential home to make the SBA lender feel warm and cozy, and got it done. So there's that ability. So in the state of Texas, can't pledge a home. That's it typically is an SBA guideline that they cross with the home. It typically won't have anything on title that shows that that they're pledging it. It's just something that is in part of the note. So yeah. Awesome. You guys, well, I think we've come to the last of the questions. Colton, he posted our email in there, and if you have any more questions, feel free to reach out to us via the email. And if you're interested in finding out more about our 3-day live commercial loan mastery training program, becoming a commercial loan broker in only 3 days, you can schedule a call. Colton also posted the booking link where you can book a call. We appreciate your time. Thanks for sticking with us. We're hoping to have more webinars on a regular basis. If you have any topics that you're interested in, want to learn more about any specific part of commercial financing, drop us a note. We'd love to create more webinars for you based on what you're interested in. So awesome. Well, we're signing off. Thank you so much, and have a great Memorial Day weekend. If you guys are doing anything fun, let us know. Love to hear about it. So thanks a lot. We will see you later.
Thanks, everyone.